So let's talk about the stock market in early 2026, because it's a bit of a paradox. On the surface, everything looks fantastic, we're hitting record highs, but if you peek just beneath that shiny surface, the champions of yesterday are starting to look like the losers of today. In this explainer, we're going to dig in and figure out exactly what's going on.
I mean, if you just glance at the headlines, the big picture looks absolutely incredible. The U.S. markets have been carrying over some serious momentum from last year, and it's not just a few stocks. We're seeing broad participation pushing the indexes into new territory. And investor confidence seems rock solid.
And why wouldn't they be confident? Corporate America is on an absolute tear. We are witnessing a historic run of profitability that has pretty much laughed in the face of high interest rates and all the global uncertainty. Seriously, the numbers we're seeing are just staggering.
Okay, but here's where it gets weird. Here's the paradox. If everything is so great, why are the stocks that have been the champions for years suddenly losing? That is the central puzzle we are going to solve right here.
All right, so first up, let's just lay out the bull case because, man, it is strong. The economic backdrop isn't just good. It's what some analysts are calling this tantalizing mix of positive forces.
Yeah, this quote here from Neuberger Berman, it just perfectly captures the mood. They're basically pointing to a perfect storm of good news: stimulus, confidence, more lending. And they see it as the ideal fuel to send both the economy and the stock market even higher.
And the engine powering all of this? It's corporate earnings. The S&P 500 has just locked in its fifth consecutive quarter of double-digit earnings growth. Let that sink in for a second. 5 quarters in a row. That's a level of performance we haven't seen in almost a decade. It's wild.
And check this out, because this is what's really amazing. So analysts, right, they went into the last earnings season thinking, okay, a solid 8.3% growth. Not bad. What they actually got was a mind-blowing 14.2%. Companies didn't just meet expectations, they blew them completely out of the water.
And you know what? We can actually see this confidence showing up in the data. This chart here shows a really clear upward trend in temporary employment. This is like a classic sign of what's to come. It means businesses are feeling good enough about the future that they're starting to bring on more people.
And it's not just about hiring people for today. This next chart shows that what we call CapEx, capital expenditures, those intentions are also on the rise. They're investing in the equipment and tech they'll need for tomorrow. This isn't just talk, this is confidence in action.
Okay, so the foundation looks absolutely rock solid, right? But when you start to look a little closer, some really puzzling cracks start to show up in this beautiful picture. The rally just isn't behaving the way you'd think it would.
And here it is. Here's the disconnect laid out in plain numbers. Look who's leading the pack so far this year. Energy, materials, industrials. The tangible, real economy stuff. And at the bottom, tech and financials. The very sectors that have been running the show for years. It's a total flip of the script.
And it gets even stranger than that. We're seeing this weird thing happen that people are calling the beat and sell phenomenon. You've got companies like Intel posting great earnings, but then their stock gets hammered just because their forecast for the next 3 months isn't absolutely perfect. GE had solid results, but then the stock took a dive on a, quote, glum outlook. Even Netflix got punished over a subscriber forecast that just wasn't quite good enough.
So what this all means is, the margin for error has just shrunk to almost zero. The market has become incredibly picky. It's not enough to have a great last quarter. If your vision for the future isn't absolutely flawless, investors are selling first and asking questions later. The bar has been raised to an almost impossible height. So what on earth is going on here? How can the economy be on fire and corporate earnings be great while the old leaders are getting punished? Well, the answer is a classic financial event called a market rotation. And honestly, it explains everything.
So a market rotation is pretty simple, really. It's just a big shift in where investors are putting their money. They start pulling cash out of the sectors that have been winning, and they pour it into new sectors that they think are going to do better in the next phase of the economy.
Here's the easiest way to think about it. Imagine you're a coach. You look at the field, you see the game conditions have changed, and you decide to bench last year's superstars. It's not that they're bad players, it's just that you're putting in a whole new lineup. Players whose skills are just a better fit for the way the game is being played right now. So, what are these new game conditions we're talking about? Well, it really boils down to 3 big things. First, that whole idea that AI would just instantly print money for every company, that trade is starting to unwind. Second, inflation is proving to be a bit sticky, and that's actually rewarding businesses that have real physical stuff and generate real cash flow. Think about it. When prices are rising, companies that sell oil or steel can just pass those costs along. And third, the market is just tired of being so heavily dependent on a handful of giant tech stocks. It's broadening out.
And that, right there, brings us full circle, back to our new leaders. Energy, materials, industrials, these are the players the coach is sending onto the field now. They're the businesses that do really well when you have some inflation and real, tangible economic growth. This is the market's new playbook, plain and simple.
Okay, so this rotation is clearly happening, but the million-dollar question is it going to stick? So what are the signs we should all be watching for to see if this is actually a long-term change?
All right, here are 4 key signs you can watch for. First, keep an eye on the equal weight indexes. Those are the ones that don't let a few huge companies dominate. If they keep outperforming, that's a big sign. Second, watch the financial sector. It needs to stop lagging and find its footing for this rotation to be real. Third, pay attention to oil prices and long-term bond yields. If they stay high, that's fuel for these new leaders. And finally, number 4, watch if big tech stocks keep selling off even after they report amazing earnings. That's a surefire sign the rotation has real teeth.
So if there's one thing to take away from all of this, it's this. And it's simple, but it's also pretty profound. For the first time in a very long time, the stocks that are going up the most are no longer the companies that are growing their profits the fastest. The market's definition of a winner has fundamentally changed.
And all of this leaves us with the one big question for the rest of the year and probably beyond. Is this just a temporary shuffle of the deck, or are we witnessing the beginning of a brand new, multi-year cycle where hard assets and real cash flow are crowned the new kings of the market? The game has definitely changed,